Let's talk about buying a house. The whole world of home loans is, well, it's about to get a major shakeup. As the market keeps shifting, lenders are having to get a lot more creative. So today, we're going to dive into four huge trends that are really set to redefine who can buy a home by 2026. If you've tried to buy a home anytime recently, you know this feeling. The prices are just sky high, the rates feel like they're stuck in neutral, and it can honestly feel like the door to owning a home is just slamming shut in your face. And if you feel that way, you are definitely not alone. And here's the thing. The real problem is that the traditional lending model, the one that was built for a world where everyone had a stable 9 to 5 job, it just hasn't kept up. It hasn't adapted to the gig economy, to entrepreneurs, to the way people work now. And that mismatch, it's locking millions of perfectly good, credit-worthy people out of the market. Okay, so who are we actually talking about here? The central problem is this huge, growing group of people who are totally creditworthy, but they just don't fit into that neat little conventional loan box. I mean, they've got the income, they have the savings, but their financial story, it just looks a little different on paper. So what's the industry going to do about this massive, underserved group of people? Well, that brings us to our very first major trend, this new wave of loans that are designed specifically for non-traditional borrowers. They're called non-QM, which stands for non-qualified mortgages. Look, it's just a fancy technical term for a loan that uses different ways to check if you can actually pay it back. Think of it as a much more flexible, kind of modern approach to lending. So who is this for? We're talking about the self-employed, right? The entrepreneurs, real estate investors, even social media influencers. These are all people with good credit, solid finances. Their income just doesn't come from a nice, tidy W-2 form. And that's the million-dollar question, isn't it? If you're not just looking at a simple paycheck every 2 weeks, how do you know if someone is a good risk? Well, the answer really lies in using smarter data. And this is where the credit score itself is evolving, which is so important. These new models, like VantageScore 4.0 and FICO 10T, are being adopted because they paint a way more complete picture of your finances. For the first time, they can actually factor in things like your history of paying rent and utilities on time to prove that you're reliable. But it's not all smooth sailing. Lenders now have to deal with something called shadow debt. And this is all the debt that doesn't always show up on a credit report. We're talking about those buy now, pay later plans. It means underwriters in 2026 are going to have to dig a lot deeper to see the whole story, both the good and the bad. All right, so this new flexibility isn't just about who can get a loan, but also about how they're going to pay it back. And that brings us to our next trend, which is a really direct answer to the affordability crisis, the 50-year mortgage. Yeah, it sounds extreme, I know, but it could actually be a key to getting first-time buyers in the door. The debate around this is pretty clear-cut. On one hand, yeah, a longer loan term means a lower monthly payment, and that could be the one thing that lets a family start building their own equity instead of just throwing money away on rent. But on the other hand, critics are worried that it saddles people with decades of debt for what might only be a pretty small savings each month. But here's a wild card that kind of complicates that whole long-term debt argument. According to the National Association of Realtors, the median time somebody actually stays in a home is just 11 years. So the reality is, most people are not holding these loans for the full 50 or even 30 years. They sell the house and move on way before that. So while some of these big changes are about helping people buy their own home, our third trend really focuses on the other side of the coin, the absolutely booming rental market and the investors who are fueling it. And the logic here is pretty simple, right? With so many people in their prime buying years struggling to afford a home, the demand for high-quality rental properties is just exploding. And this has created a huge opportunity for investors to step in and fill that gap. And they're using a special tool to do it. It's called a DSCR loan. The whole key here is that lenders qualify the loan based on the property's potential cash flow, not the investor's personal paycheck. So, in other words, if the property's projected rent can easily cover the mortgage, the lender sees it as a solid investment, and it doesn't matter what your personal salary is. I mean, this completely changes the game for investors. The whole process is faster, it's way more focused on the asset itself. It lets savvy investors build up their portfolios way more quickly than they ever could with those old personal income-based loans. The risk, of course, is fraud. Some investors have been caught just totally overinflating their rent estimates to make a property look way more valuable than it really is. And because of that, lenders are getting a lot tougher, and they're using more sophisticated tools to verify a property's true rental value. So when you start to put all these different pieces together, you've got more flexible loans for modern workers, new terms for affordability, smarter financing for investors. What you start to see is the beginning of a whole new playbook for how to buy a home in 2026.
So here's the bottom line. Your standard 15 and 30-year mortgages, they're not going anywhere. They'll still be the norm, but they're not going to be the only option. Like Robbie Robertson from Loan Logics puts it, the floodgates are opening for more creative solutions to get more Americans into a home.
And all of this leaves us with a really important question to think about. As our financial lives get more complex and the tools to measure them get more sophisticated, what we think of as creditworthy is changing, like fundamentally. That simple score from the past, it's evolving into a much, much richer story.